Have you heard the saying, riches are made in recession? It's a well-known adage in the world of finance, and it's grounded in truth. When times are tough, the wealthy often get wealthier. This is because recessions present an opportunity to invest in undervalued assets and to seize market share from competitors who are struggling to stay afloat. It's a time when fortunes can be made, and savvy investors know how to take advantage of the situation. Adversity can be a stepping stone to prosperity. During a recession, there's a lot of uncertainty, fear, and anxiety. People are worried about their jobs, their savings, and their future. But those who can stay calm and level-headed can turn this challenge into an opportunity. By looking for creative solutions, exploring new markets, and taking calculated risks, they can emerge from the recession stronger, more resilient, and more successful than ever before. As we enter 2023, the global economy is facing a number of challenges. Inflation is on the rise, monetary policies are tightening, energy costs are increasing, and growth is slowing down in many major countries. According to economists at the International Monetary Fund, around one-third of the world's economy is expected to enter a recession by the end of the year. While this can be unsettling for many investors, it's important to remember that recessions are a natural part of the economic cycle. By preparing for the downturn and taking advantage of the opportunities it presents, we can set ourselves up for long-term success. The legendary investor Warren Buffett once said that bad news is an investor's best friend. This may sound counterintuitive, but it's true. When everyone else is panicking and selling off their assets, smart investors can swoop in and buy at bargain prices. This is a classic value investing strategy, and it has been used by some of the most successful investors in history. By keeping a cool head and looking for opportunities in the midst of turmoil, you can make the most of the recession and emerge on top. So why is everyone talking about the R word all of a sudden? It's because in 2022, central banks around the world were racing to raise interest rates in order to combat the highest inflation in nearly 40 years. According to Reuters, the big guys in charge of the top 10 most popular currencies have raised interest rates by a whopping 2,700 basis points in 54 different rate hikes over the last year. That's a lot, right? The US Federal Reserve alone has raised their Fed funds rate by almost 5 percentage points. But here's the kicker. Some investors are getting a little antsy, worrying that this sudden surge in rates could lead to a recession like what happened in the 1980s and 2008. What do you think? Did you know that when a recession strikes, businesses usually take a hit? They often see a slowdown or even a decline in the earnings over time. And when that happens, they may have to make some tough choices to keep their profits up. Things like cutting costs and reducing staff can be a real possibility, but that can also mean less money being spent on goods and services, which can then create a domino effect of even more economic troubles. It's a tough cycle to break. So have you noticed that a lot of big-name companies have been announcing layoffs lately? It's not just one or two either. We're talking some serious heavy hitters in the tech industry like Amazon, Microsoft, and even Disney. According to layoffs.fyi, there have been over 160,000 job cuts in tech alone in the first 4 months of 2023. Yikes. And when this happens, it can set off a chain reaction of economic woes. You know the drill. Higher unemployment rates can lead to less consumer spending, which can then hurt GDP growth, housing prices, and even stock prices. It's definitely a tough situation all around. There, you heard me. During a recession, the stock market usually takes a hit, which means that you can buy stocks at a lower price. While the idea of investing during an economic downturn may seem counterintuitive, history has shown that it can be a profitable strategy. If you're in it for the long haul, you could end up making a significant profit when the market bounces back. This contrarian approach is based on the idea that when the market is driven by fear or greed, it tends to be irrational and overreact to news and events, creating opportunities for savvy investors who are willing to go against the crowd. In fact, this strategy is very popular among millionaire investors. Warren Buffett is a well-known proponent of this approach. He famously said, "Be fearful when others are greedy, and greedy when others are fearful." You want to try to take advantage of the fear that's out there. By buying when others are fearful and selling when others are greedy, Buffett has been able to achieve extraordinary returns for his investors over the years. So how can you apply this strategy to your own investments? One way is to keep some cash on hand. While many people used to think cash was just a useless pile of paper that would rot away due to inflation, it can be a valuable asset during times of market turmoil. When asset prices are dropping like a hot potato, cash is the safest way to protect your health. Having some cash stashed away can provide some peace of mind and give you the flexibility to seize new opportunities as they arise. Berkshire Hathaway, the holding company of Warren Buffett, is known for keeping a large cash cushion on hand for just this purpose. In fact, at the end of 2022, its cash holdings stood at nearly $130 billion. This gives gives the company the ability to make quick and decisive investments when others are retreating, which has helped to fuel its long-term success. Another way to protect your wealth during a market downturn is to focus on protecting your career. While this may not seem directly related to investing, it can be your best defense against any potential financial downturns. Even if the market takes a hit, having a stable job can help you weather the storm. Plus, you can use this time to learn new skills and potentially increase your income. If you're worried about job security, consider taking steps to make yourself more valuable to your employer. This might involve getting additional training or certifications, or taking on new responsibilities to demonstrate your value to the company. By focusing on your career, you can give yourself a sense of control over your financial future, even when the markets are uncertain. Third, when you do put your money to work, invest in companies with strong fundamentals. One of Buffett's key strategies during a recession is to invest in companies with strong fundamentals, such as low debt levels, consistent earnings, and a competitive advantage in their industry. For example, during the Great Recession of 2008, Buffett invested in companies such as Wells Fargo, Goldman Sachs, and General Electric, all of which had strong fundamentals and were trading at a discount. In the 1973 to 1974 recession, Buffett invested in companies such as American Express and Washington Post, which had strong fundamentals and were able to withstand the economic downturn. Another key strategy we can learn from Buffett is his patience and long-term perspective. During a recession, he advises investors to remain patient and not be swayed by short-term market fluctuations. For example, during the 2008 recession, Buffett famously invested $5 billion in Goldman Sachs and held on to the investment despite initial losses, eventually reaping significant gains as the company rebounded. During the 1987 stock market crash, Buffett took a long-term perspective and continued to hold on to his investments, eventually seeing significant gains as the market rebounded. As a retail investor, try dollar-cost averaging, buying at regular intervals over time, which is one of the most profitable investment strategies out there. By implementing dollar-cost averaging, you reduce the impact of market volatility on your portfolio. Think about this example. If you have $1,000 to invest in Company A, which sells at $100 a share, you can buy 100 shares. Let's say you wait a few months later and Company A's price falls to $90 a share. Your original $1,000 would buy you 111 shares now. Investing a fixed amount of money at regular intervals allows you to buy more shares when the price is low and fewer shares when the price is high. This can help smooth out the highs and lows of the market and reduce the overall impact of volatility on your portfolio. So stay the course and keep on buying. And last but not least, it's also important to diversify your investments. This means spreading your money across different asset classes, such as stocks, bonds, and real estate, to reduce your risk of loss. If you're not comfortable with a 20% drop in prices, it may be time to branch out from aggressive tech stocks and consider sectors such as consumer staples, which can offer more stability. While diversification cannot guarantee profits or protect against all losses, it can help to mitigate some of the risks associated with investing. So what do you think of Warren Buffett's advice on how to navigate a recession and crash? Are you ready to start implementing his tips and strategies? Or maybe you could have some additional ideas that you'd like to share with the community. We'd love to hear your thoughts in the comment section below. Thanks for watching, and don't forget to like and subscribe to our channel for more insightful videos.